Many large and established insurers with complex corporate structures have dozens of operating entities, some of which may have been laying fallow for years. Even if not active, these structures can present a regulatory and capital burden on the operating entity. Meanwhile, other companies are looking for a gateway to launch new businesses and are often hungry to acquire a shell company and the licenses that come with it. I'm Meg Green, and thanks for joining our webinar, Sleeping Assets Awaken, Monetizing Dormant Insurance Shells, offered in partnership with M&A Services. I'll introduce our panel in a moment, but first I'd like to invite our audience to share their questions and insights. We'd like to make our next hour together as interactive as possible. And now to welcome in our panelists, joining us first is Paul Procops, Executive Vice President of M&A Services. And Paul, welcome in. And would you like to say a few words about yourself and your company?
Yeah, Meg, thanks for having us. As a firm, M&A Services is a full-service boutique investment bank focused exclusively on the insurance industry. That's all we do. As it relates to the topic today, the shell market, we've done hundreds of shell transactions and really are the market leader in the space, doing about 90% of the market share in the US. Beyond shells, we get involved in middle market operating companies, both on the insurance balance sheet side as well as the distribution side.
Great, thanks, Paul. And up next, joining us is Diane Karras. She's Principal and Director of the Regulatory Compliance Practice for Pear and Knight. Hi, Diane.
Hi. As you said, Pear and Knight is an actuarial consulting and insurance solutions practice. We've just celebrated our 30th year, and I have been with them for 23 years. As Director of Regulatory Compliance, I have both the licensing area, so I deal with shells as well as all sorts of insurance entities and state filings. So once you buy their shells, you need to get the products out, and that's me.
Great. Thanks, Diane. And up next, we have Michael Price. He is the Chief Executive Officer and founder of Delwood Insurance Group. Hi, Michael.
Hey, how are you? So Delwood is a fairly new, fully licensed E&S insurance company focused predominantly on small middle enterprise risks exclusively through the wholesale channel and program administrators. My role here today is I think in acquiring a shell and working both with Pear and Knight and M&A Services as two of the strategic partners in forming Delwood.
Great, thanks, Michael, and thanks to our panel for joining us today. Paul, I was hoping you could kick us off with an overview of what is a shell company and how do carriers end up with them?
Yep, that's a great question, a great way to start. Really, a shell from a very high level is a platform. It's a way for a group, whether it's an insurance carrier or an MGA, to acquire a bunch of licenses at once. To break that down a little bit, it's really an insurance entity, insurance company, with a certain number of licenses. Those licenses have a certain different types of authorities on them. But with the purchase, typically will be some sort of reinsurance agreement or administrative servicing agreement from the seller. So really a buyer is looking to buy clean, good standing licenses without the liabilities that the insurance company wrote in the past. That's really kind of a high level definition. They're created in a number of different ways. They could be the result of a large acquisition where there's duplicative licenses or duplicative companies writing in similar geographies or similar lines of businesses. They could be the result of an insurance group exiting a class of business, a line of business, or a geography. Or it could just be a general corporate cleanup. A large insurance group could have 40 or 50 different insurance company entities, and they just think we don't need all of these entities going forward, and they have value. So via reinsurance, they can create a shell from something that is operating or was operating in the recent past.
Great, thanks, Paul. And Michael, I know you have a really interesting use case. Can you talk us through what you did at Delwood and what were your goals in acquiring a shell?
So simply put, there were really three objectives in seeking to acquire a shell company. Number one is speed to market. Number two is sort of having adequate lines of authority within the given framework of where we want to prosecute our business plan. And the third is what I'll just refer to as a clean shell. And I can go into all three a little bit more. Just to start on speed to market, in trying to raise the capital and we're talking to the investor class, getting up and running quickly was a key consideration to investors. They would point to use cases of de novo insurance companies in the past that spent too much time in the J curve and or had less preferred economics by needing to have a fronting carrier because in both instances, access to licensed paper was a impediment to the business plan. So identifying a shell company and saying that we could be up and running quickly was a key consideration in raising the capital. So speed to market is first and foremost. The second one, really the lines of authority, you have to have the ability to write property and casualty insurance, but have a broader mandate to write sort of adjacent lines. And so having a shell company with the appropriate lines of authority and then being fully licensed in all 50 states to do business was a second consideration. On the clean front, I think there's a couple of ways that people talk about shells being clean. Paul mentioned a moment ago that there are established insurance carriers that have extra insurance companies that may deem necessary to monetize those. In doing so, though, they typically have to sell it as a clean shell. So they'll do a novation of the past liabilities out of that shell through a reinsurance agreement. And that could be deemed clean because you now have a counterparty who's responsible for the past liabilities. So one of the first pieces of evaluation is how good is the counterparty? Because ultimately, no different than buying a home with an oil tank in the ground. You're ultimately, once you take possession of that asset, you're responsible for the liabilities in there if ultimately the reinsurance doesn't apply. So I think that's a good analogy. But even in the instance of a clean shell that's has good counterparty reinsurance, you're then still faced with the operational burden of having to process all of the claims and run them through to the reinsurance. So it's ultimately your operational costs. So when you're valuing sort of cost of a shell, really how much past liabilities are in there, what's the counterparty, and then what's the operational burden in terms of continuing to process that is our key considerations. We were very fortunate because we bought what I've referred to as a unicorn. We bought a 46 state licensed shell with the four remaining states applications pending. So effectively a 50 state licensed shell with no past liabilities. It was in and of itself a de novo. It had never had an employee. It had never issued a policy. It never appointed a broker. So truly a clean shell. It had just $15 million sitting in a money market fund collecting interest. So it was as clean as it could be. So for us, the stars really struck for us. We were very fortunate to find this shell. And with that, speed to market was key. We received regulatory approval in late May of 2024. That was the impetus for closing the capital raise on June 3rd. We were able to downstream the money shortly thereafter. And then another consideration, which is adjacent to this, is ultimately the shell's only as good as the rating from AM Best. So we were able to work in parallel to get our rating from AM Best, and we were up and running and wrote our first policy on 7/1. So literally about 6 weeks from capital raise to writing our first policy. And that's really to emphasize the speed to market. So for us, again, fully licensed in all 50 states, up and running very quickly, and truly a clean shell with no past liabilities were the key considerations for Delwood.
Yeah, that's amazing. That does sound like a unicorn. So, Diane, I'd like to get you into the conversation to talk about how do you determine the value of a shell company?
Well, when a company is looking at shells, and I'm not going to necessarily talk about the dollars and cents, but particularly with admitted companies, you're looking at, do they have licenses in the states where you need them, be that countrywide or in a key geographic area. You also need to make sure it has the right lines of authority, because each state defines their lines of authority differently. And you need to take a look at, do you have what you need to write your products? And it's not always simple property casualty. You have people that want to write pet insurance. Well, there's about 14 states where you need to have livestock in order to do that. And you need to make sure you have that in your domiciliary state, or you're going to have to go and add it. And if you don't have the lines of authority you need in all the states, once you purchase the shell, you're either going to do an amendatory application in those other states to add it. You may need to do an expansion in the other states to get licensed there for the first time. And departments of insurance, I would say, as a whole, do not move quickly when you get into that application process. So that is why people look for shells that are already licensed and have the lines of authority that they need. You also need to look at, is it a big state? There's always a premium if you have a California, a Texas, a Florida. There's something called seasoning when you're looking at shells. So if you don't already have the lines, there are certain states that are going to want to see direct written premium before they let you add those lines. And that could play into effect. So if you purchase a shell that has every line you need in every state you need it, speed to market quicker. If you still need to go in and add lines in half the states and enter into a few states, you can still take that process out anywhere from 6 to 18 months, depending on the state. But that a lot of times is still quicker than if you had to start a de novo company, get the seasoning, and then expand into all the states as you go. So even though it could take time, if you don't find the perfect shell, it's still going to be quicker than starting one from scratch.
And I think Diane perfectly summarized that. And just one point to add, and it kind of bridges to one of Michael's earlier points. First and foremost, from a valuation standpoint, the states and the number of states and the presence of the highly populated states are going to be what's driving the value. But second is really, to Michael's point earlier, it's the strength, the balance sheet strength of the seller. And that directly correlates to their credit risk and their ability to deliver a clean shell. A shell that's being sold by a multi-billion-dollar capital and surplus seller who's offering a very strong reinsurance agreement and indemnity is going to be worth more than an insurance company being sold by, a more thinly capitalized seller, because ultimately you are left with that credit risk to that seller, as they are typically on the hook for prior liabilities. So it's licenses, but then right under that is the strength of the seller and their willingness and ability to provide a meaningful indemnification as well as meaningful and fulsome reinsurance.
Thanks, Paul. Michael, did you want to add to this?
Yeah, I mean, in terms of value, again, I think those are all the points. I mean, maybe just to put this in terms of an example again, we did have multiple shells we were evaluating. Some were being sold from distressed buyers, where we were effectively looking at the counterparty as sort of less adequate. Now, just to put a little numbers around that, those shells were about $4 million cheaper than the one we ultimately purchased. So again, coming back to where we ranked credit risk and past liabilities, and frankly, I do want to emphasize again, operational burden. All of those considerations made us feel like the extra money that we spent to buy an extraordinarily clean shell with no past liabilities was the key consideration for us. The other point I'd make is just the idea of seasoning. Maybe one other point just on E&S, because I do think the seasoning really is more of an admitted company phenomenon. In E&S, because again you're not admitted in the states, there is one additional consideration. There's a handful of states that have what's referred to as a domestic surplus lines license. So what that means is you're not admitted even in your home state. Not every state operates that way. Only a handful, I think it's 7, Paul, that have domestic E&S privileges. And so being an E&S carrier and having only one insurance company today, Delwood Specialty Insurance Company, being non-admitted in all 50 states was a key consideration for us. So home state, I think, is another consideration. We're domiciled in Arizona. Arizona is a domestic E&S state.
Yeah, that's a great point, and to bridge that to the admitted side, shells that are domiciled in tougher regulatory states. And I sit in New York right now, and that's not an easy state to operate in. It's one of the few states, or it's the only state that you can't redomesticate out of. But a state that is a shell that is domiciled in a state like Arizona or Delaware is going to be valued probably higher than one that is domiciled in New York or California or another difficult state where you have a higher regulatory scrutiny or regulatory burden to cover.
Thanks, Paul. I have a couple follow-up questions. And along those lines, Diane, you had mentioned California, Texas, and Florida. Would they be more valuable because of the population of those states, or is it a regulatory issue?
It's both, particularly with California, to get a license in there. California is unique, operates slowly. I would say if we're doing expansion applications in California, it could take up to 2 years, if not longer.
Mm-hmm.
There's also the consideration of seasoning. And seasoning is looked at 2 different ways. There's what I've termed operational seasoning, which is the insurance company needs to have been in existence and operating. And then there's direct written premium seasoning. So, but the operational seasoning, that's one of the reasons people buy a shell. It has been up and running, whether it's different ownership, for whatever reason, the states still look at it as far as the company's been up, it's been operating, so they're not going to put the seasoning requirements on there. There's about 10 states that look at direct written premium seasoning, and they want to make sure you have experience in that line. And they will look at the 5-year history on the annual statement of whatever shell you're buying. And if you don't have experience in that line, which in a lot of times with shells you don't, they're not going to let you add it until they see that direct written premium on your line. There are waivers. Sometimes you can get, sometimes you can't. For example, in Florida, I've seen them grant waivers based on the management experience, but you're going to do a full pleading of your case to show that you have the experience to operate those lines successfully in that state. Connecticut doesn't offer seasoning waivers all that much. So if you don't have the line you want and you want to add it on that particular shell license, it's going to take time. They're not going to let you do it right away. So that's definitely something to look at. And that is one of the reasons that you can get quicker into the market, is if you have those licenses with those lines in those states that are going to look at that. And I did want to talk about the DSLI, or the domestic surplus lines insurer. It's actually up to, I think 22 or 28 states now that allow the DSLIs. 10 years ago, even though some states had them, I never saw people really operating them. And I I didn't understand why, because the more traditional way with surplus carriers is you're admitted in one state and then you can write surplus in all the other states. So if you wanted true countrywide coverage, you actually needed two shells because you had to have another one to write surplus in that state where your traditional surplus carrier was domiciled. So yes, having that value of getting the DSLI where you can write surplus in the resident state as well as all the non-resident states is important, and it is something you're seeing more and more of these days.
So Diane, that's great. I actually just learned something on the call too, because I didn't think it was up to 2 now. That's really, that's good to know. But again, that was for us a key consideration.
Yep.
Michael, was the seasoning an issue for you with the fresh shell?
No, because again, it was already licensed in 46 of the 50 states, and the applications were pending in the 4 states that we weren't already licensed in. And those really were just around minimum capital requirements. Most states require sort of a minimum of 15 million, which is really what was sitting in the shell. The other states, the big states like California, New York, Massachusetts, as examples, require 50 million. And so because of that, it was just about once we downstreamed the capital, the application was sitting pending. And once we downstreamed the capital, those applications were approved within 30 to 60 days. So we were fully licensed quickly. The seasoning really is more of an admitted phenomenon. Diane, correct me if I'm wrong there, but it does come into sort of the analysis of buy versus build. So we did look at that analysis very early on, buy versus build. But again, for the reasons we said earlier, speed to market, build was just not an option because it would take up to 2 years to get licensed, or maybe more in all 50 states. So for us, acquiring the E&S shell was critical. However, in the admitted world, now we're a wholesale only shop here, and that's not going to change. But as you know, there is admitted business in the wholesale and program channel. And so while it's not core to our business plan in the short run, having access to admitted paper over time is deemed a strategic imperative for Delwood down the road. So what we've now done in the admitted world is we're doing the build scenario. So we actually have just recently incorporated a company in Arizona, since they're already our home state regulator, and we're going to start going through the seasoning requirements. So we're going to start with one line of business in Arizona, write some premium there in 2026, probably in our management and professional lines area, and then use that as a means to go out and seek approval in other states as well.
Okay, and if I can add one other thing there, I know, Michael, you're saying you were licensed in all 50 states. I think it's important to realize that surplus carriers aren't technically licensed. They have a license in their domiciliary state, in this case, Arizona. They have the minimum 15 million, as you said, for most of the states, 20 million for Massachusetts, 50 for the other. They are registered in the other states to write surplus. They are not going through the full licensing process. It is the registration to get on the white list. If it's a state that has that, they can operate there. California, still being California, is the only one that has seasoning on getting on their whitelist, but you can still write business without it. So it is different than in the admitted market, because in the admitted market, when you're purchasing the shell, they need to be licensed in every state, which means every Department of Insurance is not only looking at the surplus in the shell, but they're looking at the management experience, the sales, the distribution. So whereas you might have answered those questions during the Form A to acquire it, when you're doing an admitted company, all of the states are looking at that because they truly are issuing a certificate of authority to write business in their state, and they are going to regulate everything you do, including all your rates, rules, and forms.
Yeah, I think the seasoning is really just primarily an admitted issue that folks have when they are forming an entity de novo, and that really comes into the discussion that potential entrants have as to, do we have a number of years to go out and meet seasoning requirements, or does the business plan require us entering the market within a year? And that's really the build versus buy scenario discussion that groups have.
And there's other things to look at. So if you're buying the admitted shell, and if you're not in all of it, or in all of the states already, you need to have a financial exam within 5 years. There are states where if it's old, you can't do it because you are submitting all of that documentation to the state. They want something current. Full biographical affidavits that each of the states are going to look on the directors and officers and 10% or more shareholders. You're going to have to join all the guarantee funds if you're out there, if you're writing property, if you're writing auto, which is something that doesn't apply on the surplus side since it is surplus. So there's other considerations as well to look at. And the more you have, the more licenses you have, the more lines of authority you have. And I would say mapping the lines of authority as well is something that is hard to do because, as I said, none of the states have the exact same lines. You have Tennessee, which basically has property, casualty, and surety on their lines of authority. And then you have states like California or Florida that have over 20 lines of authority, and there's some sort of mixing and matching on how you do it. If you're going to write a CMP coverage, you're going to need to get all the individual coverages for what your product is going to offer, whereas in other states it'll be 2. So it's not as easy as some people think to look at here's a list of licenses I have. Am I going to be able to write the BOP program I want to write? Am I going to be able to write the contractors program? You really do need to do an analysis on each and every line.
That's helpful. And I think Meg is having some technical difficulties. So I think it might make sense maybe to hop in and answer one of these audience questions. Question on clearing the balance sheet via runoff. What if the shell has a series of open claims? Does walling off those reserves makes much sense? There's a couple different ways to handle that. One of the biggest sellers of shells historically has been Berkshire Hathaway after buying entities out of runoff. I guess to answer that question, it would depend on if you have an insurance company has other entities within the group that can assume those liabilities via a portfolio transfer or some sort of quota share reinsurance agreement going forward. But it really, to answer your question, it doesn't necessarily, if you have another entity, it doesn't necessarily make sense to wait to sell to sell it as a shell when you can clean up the vehicle, that the shell company via reinsurance. But if you have no other entities, and that is the entity that you're looking to sell, then potentially it makes sense for those claims to run off further, so that you have something clean that from a value perspective.
And again, you use Berkshire, so we can start there because I think by all measures, probably the, in terms of counterparty risk, in terms of collection of reinsurance, it's, is highly rated and is highly capitalized as any company out there. But again, the devil, Paul, is, I think you would agree, is in the details with respect to the terms of the reinsurance agreement, potentially the claims TPA agreement, and really what other contractual indemnities exist. So, just take, for example, I know the question talked about workers' comp, which is a long tail, but maybe we'll use like a commercial auto example. So you acquire a shell that historically ran commercial auto business. If I were to buy that, I'd want 100% quota share reinsurance of all the past liabilities unconditionally. But with that, who's handling the claims? Are they going to still handle the claims of the runoff entity? If so, first of all, I wouldn't want to participate if we were then not only handling the operational burden of the reinsurance, but also administering the claims. But then you also have to look at just the extra contractual damages of bad faith or sort of ECO, any of those types of issues, and you just want to make sure that the contractual indemnities really do wall off all of the past, and so what you truly are buying is clean and free of any sort of claim, bad faith, or reputational risk, all of which you just want to make sure highly contained.
Yep. Yeah, I would agree there.
Hi, sorry so much. I'm having internet difficulties and sorry to drop out, but thanks for carrying on the discussion. And thanks for answering the audience question. Thanks for bringing those in. Continuing with our prepared discussions, Diane, what regulatory concerns should be top of mind for people when it comes to shells?
Again, I think the key component is going to be, do you have the licenses in the states where you want them? And are they in good standing? There have been cases where I've seen shells where one or two of the states had the licenses in suspense. So you, in essence, were reapplying for a license in order to reactivate that. The directors and officers, when regulators are looking at shells, they want to know that the directors and officers have company experience. You see a lot of people when the insurtech and the fintechs that are very used to coming in and maybe dealing with limited regulations or one set of regulations, but explaining to people that insurance is state by state. They're going to look for expertise. They're going to do full background checks on the directors and officers, 10% or more shareholders. And they want to know that you know what you're doing in regards to sales, marketing, underwriting, reserving, claims. Even if you're hiring other people to do that for you, they want to make sure that let's say the top of the insurance company is still in control of what's going on with the shell. I'd also add that years ago, there were what we would call fronting companies, but you weren't allowed to call them fronting companies. Regulators really did not like that term at all. I'd say in the last 7 or 8 years, that's primarily what I've been dealing with is companies buying shells because they want to do program business. And I think that's what Michael's doing on his. But the way they present that, and they're coming in with, well, I'm going to use MGAs, that's not always going to sell the regulators. As I said, you need that expertise. They look at that program manager business as it's a contract away, and if you get into a fight, then you lose all your expertise, so you have to have that there. That is something to consider in addition to the general health of the shell and if it's in all the states that you want.
Thanks, Diane. Oh, Michael, jump in.
Yeah, no, just a couple of points of emphasis. And just for clarity, Delwood is a full stack risk taker. We're not a fronting company. We participate with our own paper and take significant risk. And where we participate in the programs channel, it is sort of using our own paper and taking the risk similarly as we do in the brokerage markets. But I think the point about being a fronting only carrier is a valid one. Going through having just recently gone through the Form A process just 20 months ago, it is a process. I mean, there's biographical affidavits. You have to demonstrate your expertise, and then they do look to the ultimate parent. So we do have an all-star lineup of investors at Delwood, but a couple of them are insurance companies. So in that regard, the Form A process for those particular owners was a bit smoother. But then with the individual investors, each one of them had to go through, if they own more than 10%, had to go through the same Form A process alongside us So that it really is a thorough evaluation by the regulators in order to acquire the shell. You have to demonstrate the expertise that you can be a good owner of that business.
And you had to demonstrate it in the one state for the Form A when you're dealing with the admitted companies. And if you don't have what you need in those states, you're going through that same process in all the states. And they all look at things differently. It is amazing that some states it'll do your application, it's complete, okay, you're approved. And then there's other states where you're going to be redoing the pro formas on the projections. They're going to be asking much more in-depth questions, and you could be getting them from multiple states at the same time, as opposed to just the Form A, which is whatever state the shell is domiciled in. That's the approval of the acquisition.
Thanks, Diane. And thanks to the audience sending us some great questions. I've got a follow-up for Diane, which can you clarify what it means to need experience in the line you want to add? Does that mean the buyer needs to have that experience on their existing entities before adding the shell?
It's not on adding the shell. It's more if you're adding a line. So we'll take Connecticut, for example. So you purchase a shell, you have a license. And I see also that one of the audience questions is, what is the difference between a license and a line of authority? The license is your certificate of authority to do business in that state. On that license are certain lines of authority. As I mentioned, Tennessee has property as a line, casualty as a line, and surety as a line. You look at states like California, you're going to have homeowners, multiple peril. You will have fire and allied lines. You will have glass. You will have elevator. You will have sprinkler. They will break it down a lot of different ways. They have teams, which I think goes back to when they had horses that they had to insure. So there's different regulatory lines that you need to look at, and they all map differently. So you get the license, which is you can do business, but then the lines of authority tells you what products, what coverages you can offer in that state. So you could purchase a shell, and let's say it has property in Connecticut, but it does not have vehicle, and you want to write auto. They're not going to let you add auto to your certificate of authority until they see you write it in another state. They say your domiciliary state, but it could be any other state in the shell that you bought. And if you're buying an empty shell that hasn't had business for the last 5 years, you're not going to have that experience. They want to see direct written premium. Those, again, it's 8 or 10 states that require direct written premium seasoning as opposed to operational. So if that's the case, that means you can start writing vehicle and commercial auto in the states where you have those lines of authority on those licenses that you purchased, but you're going to have to wait. I believe Connecticut might be 3 years. You're going to have to wait 3 years before you can add it in Connecticut. That is the DWP seasoning. So you're going to have to, it's basically, I always look at it as states saying, figure out what you're doing in your home state. Don't figure out how to write something in my state. And that's why they're looking at that direct written premium.
Great. Thanks, Diane. Paul, could you talk about what are some of the considerations that potential sellers should be thinking about?
Yeah, I mean, I think the biggest consideration that sellers should think about is how to clean up a shell. Most of these shells, I mean, other than Michael's unicorn earlier, most of these shells have had operating history, right? A lot of them have been in business for 30, 40 years. So, you know, a seller needs to have an understanding and have a concrete path as to how they're going to make it a shell and clean that up via reinsurance. That's probably the biggest consideration, just, you know, how to create a clean shell. The second would be really kind of, and this is as you go to market and try to determine your valuation, right? Where are we going to be at the top end of the valuation range? Or are we going to be in the middle of the range or at the bottom? And that could be based on, the number of states and the presence of those highly populated states. But, to Diane's point, right, she is focused on adding, amending, lines of authority or certificates on an entity, right? A company that is a monoline surety company is not going to be as desirable or valuable as something that is authorized in as many lines of authority that are out there, right? So, first and foremost, I really think it's the historical liabilities and how that's handled going forward, both on a reinsurance, but also as an admin and who's doing the work, who's handling those claims. That's having a concrete plan before going to market is important there. But then certificates of authority and stuff like that would probably fall in line after that.
Thanks, Paul. Diane, a quick follow-up from the audience. Is public auto considered a line of authority?
It is not. It is a product, but it is not a line of authority. What you're going to see when it comes to the auto lines of authority is you will have personal, and again, it depends on the state. You may have personal auto, you may have commercial auto. They may break it down to auto phys damage, personal auto liability, all other commercial auto. But it doesn't, there is not a state I see that's specifically breaking out public auto from that. That would be more of a product design, but you need to have the vehicle or auto coverage in the states where you're going to write it.
Thanks, Diane. If I could bring in another audience question, this one for Paul. Are there differences in valuation methodologies for life versus P&C shells?
Not really a difference in the methodology. You're really still looking at the same factors, right? The number of licenses, the creditworthy or the balance sheet strength of the seller. Historically, there used to be a difference in the actual valuation, like where these entities were trading. But now with all of the new annuity writers, a lot of the alternative asset managers, your Athenes, your Apollos, your Guggenheims, your Aquarians, plus a lot of the fintech or simplified issue direct-to-consumer life companies that have entered the market. Really, the valuation between property and casualty shells and life and health shells have become closer to parity in recent years.
Paul, have you seen an increased demand for the shells? I mean, is supply and demand playing a role in the valuations?
Yeah, 100%. I mean, if you look at historically, I would say nowadays there are more, a higher number of buyers, but also a more diverse group of buyers, right? You're seeing, more private equity get into the space. You're seeing more MGAs who are looking to kind of diversify and expand and become kind of full stack carriers. You're seeing those simplified issue term writers on the life side. You're seeing those annuity writers enter the space on the annuity side as well. And there's been a number of new fronting entities into the space recently. So there's definitely more buyers than there were historically. I think during COVID, that supply and demand imbalance was very strongly weighted towards the demand side, but we're starting to see it more balance out as kind of things normalize.
I wanted to jump in. I know that both Michael and I have been using the term Form A process, and I thought I'd explain that. That is from the Holding Company Act. the acquisition of an insurance carrier. That is what you're applying for. And we are talking about shells, which from this conversation here have been empty. If you're talking about an acquisition where someone might have market share, maybe you're a small regional carrier that you're writing personal auto and you're looking to buy another company that has personal auto and some more. There is also a Form E process. And when you're in that situation, they want to make sure, the states want to make sure that you're not, it's not affecting the competitiveness of the market. So in those cases with the admitted companies, you actually have to get pre-approval to do that purchase, and then do the change of control once the Form A is. So there's a bunch of different Form A's, Form E's, Form C's, Form D's that go into that process once you acquire a shell, particularly if it's going to be part of a larger group that you need to be aware of and do the follow-up regulatory procedures.
Thanks, Diane. If I could follow up on something Paul was talking about earlier, and from the seller's point of view, trying to make sure the shell is clean. So they have, is that where the legacy carriers could come in, that they could try to move a book of closed business off the shelves, so to speak?
Yeah, I mean, if you look at some of the biggest sellers of shells in the space, I mean, it's your White Mountains, it's your Berkshire Hathaways historically, right? And they've bought underperforming insurance companies and have typically via a loss portfolio transfer have moved those liabilities off the balance sheet of the shell or the target entity, and then offered a guarantee and administration beyond that. So legacy carriers historically have been big players in this space.
Do you see it growing as an opportunity for the ILS market to securitize some of these risks?
Potentially, we haven't seen that yet, but we'll see.
Great. And are there any pitfalls, or I guess maybe we can delve a little bit more into it? What are the pitfalls maybe to look out for from a seller and a buyer's point of view?
I think from a seller's perspective, having a concrete plan about going to market, right, as it relates to how the liabilities will be handled and administered, right? That's something that you want to get down pat before you go to market. Pitfalls from a buyer's perspective, there could be a couple, right? It's the same credit risk, the liabilities on the buy side, right? It could be, to Diane's point, suspended or restricted licenses that need to be handled either as part of the transaction or post closing. But the Form A process that we've kind of discussed has, it is a difficult process. It's something that a buyer needs to be prepared for. I mean, Michael can go into it. It's a thorough examination and review of a buyer.
If I could jump in also on, again, this would be on the admitted side. You also have to be planning to write business. You're doing part of it. What you're doing is the pro formas. You're doing a 3-year pro forma, California 5. But there are states that have written into their statutes that after getting the license, if you're not writing business in X amount of years, they can either take that line away or suspend the license. So if you think you're going to purchase a 50-state shell, but you're not going to write business for 4 or 5 years, that's going to be problematic. Like I said, I think Florida has something in their statutes about 2 years maybe, and I could be wrong with this. Connecticut has something. Pennsylvania wants to see you writing business within a year, and meaningful business. Because with the admitted, they're doing that full review as the purchase, they don't want to waste their time reviewing you if you're not going to write business in their state, because there's requirements on their side once you're an admitted company to do. So that is something you can build slowly, and you need to make sure you have the surplus to support the business you're growing, because they don't want you growing too quickly. But I would say you need to have a plan to write some business there. You just can't say, I'm going to buy a shell and in these 10 states, I'm not going to write business for 7 years. That will not be viewed nicely by the regulators in all of the states.
Yeah, I can jump in here too. I can just sort of some tangible examples. You know, I mentioned it briefly before, but we talk about the regulatory paradigm here. There is also what I refer to as the de facto regulator, which is the rating agencies, because without sufficient rating to get past the security requirements of your distribution partners and ultimately the end user customers looking at you as being financially sound, the shell is effectively worthless if you can't use it to write business. So in that regard, you do have to work in a parallel process. So as we were going through the capital raising, there were two sort of key components to it. Obviously, there's many more others. You know, what's our business plan? Will we make money? When will we make money? All that sort of table stake stuff. But when it really came down to it, it's, do you have access to a clean shell, and can you get up and running quickly? And will AM Best, in this case for us, who is our rating agency, will they sort of validate that plan? And so you work in parallel. And I guess the good news is the business plan is essentially the same. So the 3 years of forward projections that we put forward were able to give us what's referred to as a preliminary credit assessment from AM Best. And then we were able to use that also. That was also relevant even in our discussions with the regulators about why we were a suitable buyer for the shell we acquired. And so you're kind of going through that process in parallel, and the two converge at the time of the acquisition. So by having that PCA in place with AM Best already, based on the same forward projections, we were able to pass the Form A requirements, acquire the shell, and then achieve very, very quickly the conversion of that PCA into an actual credit rating from AM Best.
There's a question from the audience on the Form A. Yes, the Form A is only required in the state of domicile. That is the acquisition of control of the domestic insurer. So that is where that's filed. Another thing to consider with the shells or the admitted shells is you need to file rates, rules, and forms. There's California makes you submit the filing in conjunction with the application. There is another state that requires that. I'm thinking Idaho wants to see that in conjunction. The rest of the other states, you can't file until you have that license and you have that, and make sure you have the line of authority for the product you want to file. So that's something when you're talking about speed to market, there is the acquisition of the shell, making sure that license is recognized in all the states. You have the lines you need, but then you need to submit rates, rules, and forms, which add something. So you can be preparing those or developing those while you're doing the licensing part, the change of control notifications, but you can't file them until everything is closed. So.
Thanks, Diane. Paul, we have another audience question. Are you seeing more demand for admitted shell companies or E&S shell companies? And what do you think are the reasons behind that?
Yeah, probably these days it's more E&S companies than admitted companies, and I think I think that harkens back to kind of, Meg, something we discussed at maybe another webinar, the growth of the specialty markets and just programmatic carriers entering the space. But historically, it would be the admitted markets, but today we're seeing more on the E&S side.
Great, thanks, Paul. I want to thank our panel and our audience for tuning in. We're running out of time, but I'd like to go around our panel one more time and ask for closing thoughts, what you would like the audience to take away from our discussion today. And if we could start with Michael, and then we'll go to Diane and then Paul.
Yeah, I mean, for me, again, we talked about Delwood's objectives. In forming Delwood, it does take a village. Any new de novo insurance company takes a village. So having M&A Services as our banker for the acquisition of the shell. We used Per and Knight for expediency to get all of our forms done, and they did some actuarial work for us. And then we also had Foley and Lardner, who was our business formation and regulatory counsel. Some of those services Diane can provide as well. But we had sort of a great team around us. And I think anyone that's sort of thinking entrepreneurially about sort of entering the insurance market in this way, you're always going to do better with great advisors. And so from that perspective, I hope this seminar today is useful, but it doesn't ameliorate the need for having really great professional advice along the way to make sure you all those pitfalls you talked about are avoided.
Thanks, Michael. That's great. Diane, we'll come to you next.
I think what I want people to go away with is they need to know what they're buying, that there's a lot of considerations beyond the balance sheet. There are considerations on licenses, lines of authority. What do you want to write? How does it match up to what you have? What are you going to face in the other states? So just having a comprehensive picture of, I have a shell that's licensed in all 50 states, but what does that really mean relative to my business and what I plan to write immediately in the future when I purchase that?
Thanks, Diane. And Paul.
Firstly, I would like to thank all the other participants and panelists here. It's been great to share the digital stage with you. But for sellers, I think it's having a plan, knowing what you're selling, having really just getting a handle on those past liabilities and where that company is going to be in the market. And to Diane's point, as a buyer, having a good idea of what you're looking for, having a plan, business plan that will get through, both the Form A as well as AM Best if that's required for you.
Great, thanks, Paul. So I'd like to thank our panel, Paul, Diane, and Michael, for sharing your insights with us. And thanks again to the audience for tuning in. We'll have a replay available in just a few moments. From Insurance Insider, I'm Meg Green.
Thank you.